11/24, 2010. We're gathered here today to look at the weekly S&P 500 wall of resistance at the 20-week moving average. Now, having said that, moving forward, we are going to be buying various put side of the market based on us coming up and hitting the wall of resistance. We were oversold on the S&P in the short term. The S&P got down to 1343 on 11/11 of 2012 during that week. We put the bottom in. From that period of time, we have rallied up to this weekly intraday high of 1409. So if you go 1343.36 minus 1409.16, that is the total dollar movement off of the bottom for the week. This last holiday week, from 1359 on the low end of this last Thanksgiving week, today is Saturday, we went from the low of 1359 to 1409 on the high. That was a total of $49.28 movement from the bottom up in the S&P. During that time frame, this is a weekly put option that was up here at $60. It's a weekly one, December 12th, and here's what it looks like. So we have put options in here, 1410, 12/7 weekly. We have a 1420 we're going to be watching. We can see how much money that the put side has come down. It was inflated, meaning that when the markets were oversold, the put side had already peaked for the short of the S&P 500, and it needed to be cashed in, and the calls went up in value. Now that we're going to go to the major wall of resistances, we're looking at a 1375 put. We even have a 1300 put in here. Now, depending on what Washington does, in Washington, D.C., we have a $1,400 put that's going to be tradable. This is a 1222 one, and let me show you how cheap this one is. This one here is a calendar monthly expiration year end on the monthly. And you can see here where the puts during the calendar week of beloved Thanksgiving is that you can see here that the highs were $62 a contract. Now, when we take a look, we're always looking at where these contracts were tradable. So when the S&P was in correction, they went from, let's just call it from $20 to $62. They made a great move here. If you had 10 contracts and you made $40, you made $40,000 when the S&P was diving down to those support levels. This is that put contract, and the premium, the lower the premium goes, the bigger the buyer we are. Why? Because people that held on to the puts at $60 a contract, they lost $42 a contract. That meant if you had 10 contracts over here at $60,000 and they're worth 18, the close was, let's take a look and see what the close was on the contract. The close was $18.60 and the low was $18. The high was $23.50. So basically, what I will show in relevance is that when the S&P 500 index comes up and hits its resistance levels, the 10-week moving average, the 20-week it's sitting on, and it got support at the 50-week. The upper end of the move at resistance will take these down in value, lower price level, and it's going to be close to the strike price, meaning that during the rally, the rally was a light week. We had Monday, Tuesday, and Wednesday. Thanksgiving was off Thursday, and we had a half a day on Friday. During these rallies, called holiday rallies, there's a certain way to trade it. And what they did was, from when Obama came out, we were up here on the S&P. We broke all the way down to those lows that I talked about, the weekly lows when he came in. That was 1343. and from 1343 all the way up to 1409, that is what we call an oversold relief rally to resistance in the S&P 500. The thing that we do with our MMTs, because we trade these call options and these put options, it's deflated. It is truly deflated below the market. Now, when we take a look at where the conviction is that these December 7s, these are going to be tradable. When we get into the monthly expiration, look at here. People, these are the open interest on the contracts. I mean, people really believe that we're going to go off a fiscal cliff because look at the volume at these strike prices. A $900 put option below the market, 121,000 contracts open. So we do take a look at the open interest. The 1,000 put has 160,000 contracts open. And these are all monthly expirations. The 1075 put, the 1050 put's got 82,000. 139,000 contracts open right now at 1,100 strike price. People believe the S&P could go down there. That volume is there. Look at the 1,150 below the market, 129,000. And as we go through, we get up here at $1,200 put at 207,000 contracts. You get to the 1,250 put, you got 203,000 contracts open. That's called the open interest. You get here at the 1,300, you got 181,000 contracts that people believe they're putting, they think the S&P can really fall. And there's 181,000 contracts. That's institutional. Here at the 1350 strike, we have 149,000 contracts. So when the S&P comes back down in value, these will go way up in value. And we will make a boatload of money. We'll do these live trades at the $1,400 strike price. Look at here, my friends, 232,000 contracts open. Let's throw it in the daily chart. Here it is. This is that $1,400 put that I'm talking about. I'm going to throw this in here. It's a December regular monthly. Right here, 1,400. This is a great trade. It's close to the strike prices. Yes, people are buying well below the strike prices. This is going to be the other one that we're going to be looking at because this has got big, I mean, these people have been piling in here. So, once again, the money is made when the S&P 500 falls. It went from $18 over here to, well, the high on these contracts were $65 on 11/16 during that holiday week. So the contracts went from $65 down to $18. Listen, understanding the directional price movement, we're hitting a wall of resistance on this S&P, and when we come up and we start to reverse and the fiscal cliff is in play, this is the side of the market again that broke, and this was a great trade. You're buying that $1,400 put when we were. Look at that thing, and this is a December 22nd monthly. Look at that thing break out from here. That was a big trade. You had 10 contracts at $20 for $20,000, and you sold them at, you didn't have to sell them at $65. Say you sold them at $60. That's $40,000. Yes. Now, the same value up here, people that don't know when to sell them, now they're right back here to that value again. That means that this weekly S&P chart, as it is that going to approach the 20-week? It's testing it. The 10-week is rolling downward. Any up movement without any resolution out of Congress, this is the side of the market that will pay big money. And just let me tell you something, everyone. This is all done before the fact. That's why we're here on Saturday. Because these contracts have already paid big coin when that S&P was in its correction. And I can tell you again that every oversold index has a relief rally, and they always happen during these time periods. Now, just for the sake of it, what I am going to do is we're going to be monitoring this 1222 1390 put. This one here has come way down in value, and that's below the strike price. We will be trading these on an intraday level. They do have range, that's $4.40, but they can get bigger ranges. So if this thing comes down to, let's say, $8.50 and then wants to go back toward $40, I make a lot of money. But I better understand something. And here's the part that I better understand. I better understand where that weekly resistance is. And I better understand what this daily oversold rally was about. We were oversold on everything. And you don't just go straight down. You have to rally back up. On the daily, you're above the 200, the 20-day, and the 100-day moving average is where it's at resistance. And then up above here, the 50 days right below, right above 1420. Now, in the first reversal trend, they don't come out and do the right thing. These lows can be broke. There could be a lot of tax selling that could come back into the market. The fiscal cliff is real. That means that during the holiday, they used no volume, everyone was gone, and they walked these things right back up to this daily bar here on the S&P where it really broke down, got below the 200-day moving average. We called that. But then when we got down here and didn't want to go lower, that was your Thanksgiving and part of your Christmas rally that's in here in these 5 days from the 5-day bottom here. So we're going to hit this wall of resistance. That's the daily on the S&P. The weekly right here is on the S&P. The 10-week moving average is 1419. That's the upper end. That's 10 handles higher from the close. That's going to be the 10-week. The 200-week moving average way down here, calendar year end, that's 1183. But more importantly is, let's take a look at the 50-week. That's at 1368. Let's take a look at the 100-week moving average, this line down here. That's 1318. Let's take a look at the weekly movement. It was $49 from the bottom up. That was great for the call side of the market. That's going up in value. Now that we have played that role, starting Monday, we're going to see where the wall of resistance tests. And once again, we will be looking at the S&P 500 index put options at resistance. They pay the money. So we'll be looking at trading the 1390 put. It's a 1222. We already have showed here that the 1410 put, that we can also trade that. That's a weekly 12/7 options expiration. One of the things that in the short term, when I go up and hit resistance, these are not, they were 3162. The low is 1670. That's the kind of range. So they gapped them from 1930 down to 1670. Only had a $2.60 range then. Take a look at the close. 3162 down here to 1670. That is cheap based on this hitting that wall of resistance. If Congress doesn't come through with anything, selling will pick up in the index. This put option will pay a lot of money. And so will the 1390 1222. And so will some of the others. Should this be the case, you can see that people are really getting a lot of open interest in these put contracts on the S&P. I don't think that Congress in the short term can do what we need to do. That's yet to be seen. So far, their track record says they don't. The thing about it is, my friends, is what side of the market do I get to buy cheap? It's this side. They took all the premium out during the Thanksgiving week. When I buy these cheaper than anyone else and I sell them back, like I showed in the other video on some of these strike prices, that's where we want to be. And the thing about it is, here is a 1400 put. That is that 1400 put. It's a monthly. That's the one that expires 12/22. It is dirt cheap. They can come down lower in price based on S&P going up and hitting the resistance level. Then the value would come down where we would get it. A reversal back down, so you know the S&P was oversold, but now it's not nearly as oversold because you had this weekly movement. And we are giving out special training on how to trade calls on the S&P when times are good, but when times are not good. When times are not good, you can see how the $1,400 put paid the big money right here. When that market was tanking, these were going up in value. Now that we rallied up to the resistance levels over here on the weekly, right here in this video, right there, that's the wall of resistance. That means that the lower price level, if these go a little bit lower in value, they're going to find their support level. And if we come right back down in a reversal, these are going to go straight right back up. There is a huge trade to be made here. We will be doing this trade and updating it on calendar Monday when everyone is coming back from their vacations this week. And remember, nothing ever goes straight down. They have to have, when they're oversold, they have to rally up, but selling into the rallies is a key here, and then buying this cheap put. Another thing that we're going to watch, the fear indicator called the VIX. And the VIX is a fear indicator. It's at 15. That means that this is at historical low levels, and we are going in to a major fiscal cliff event. November and December are to be the best calendar months for Wall Street. And that's where monies are coming off of the sideline. Right now, they don't want to. What I am showing is that the fear indicator, called the volatility index, here it is. This goes with this S&P 500 index. And we're hitting a wall of resistance, and we don't have that much fear in the market. We're down here at 15. I can tell you, though, that it's got a major support level in this, and when this goes up, that means this comes down. So when fear rises, when this breaks out on the daily chart going up in value, the S&P 500 will go down in value. The higher that we start to see where this works, then the selling would increase. There is a lack of fear right now in the marketplace, and that's that chart right there. So it's important for us to understand where the fear indicator is. They're at lows, and they usually are this time of year. But when we sold off and the fear was up here at 19, it dropped back down here to 15. When this went down in value, that's when we had this great rally from those lows up to 1409 here. When the fear went down, the S&P went higher from its oversold condition. So now what usually happens is the following Monday after the Thanksgiving week, and that's going to be upon us. Today is Saturday, but Monday comes around, that's usually where the selling starts again. A lot of people believe that there's going to be a resolution. It won't matter. What does matter, though, is this. What does matter is how the wall of resistance works and how the fear indicators are working. And then how do I make my big money when the S&P 500 goes down in value again? Okay, when it hits resistance and has the next reversal. This is where the big money will be made the second time around. And once again, you want to be where that money is going to be made. So I will conclude that the $1,400 put is right here. It's a monthly expiration. At the current level, there are 232,388 open interest contracts. So a lot of people believe with that kind of open interest right now at year end at 1,400, it's been an accumulative interest. Those are the open contracts. A lot of people think they're getting paid on this $1,400 put. On the other side, when you look at the $1,400 call, which is the opposite side of that put, I will show you right here what the call looks like. Here's the calls. These call contracts, when the S&P rallied, they were good down here, and the low on these were buyable. $6 they could have been purchased. And you know, when you're buying these contracts, when the S&P was oversold, these contracts were deflated, the $1,400 call. So when the S&P was at 1343, this was up and out of the money, And these were dirt cheap here at $6, and we just went to the high in that 5 day period. So we buy the calls to go up in value, and now the calls have gone from $6 to $23 here. The high of this contract was exactly $24.40. So if you're buying over here at $7 for the S&P to go higher in value to resistance, you make a lot of money. However, now that the backside of that trade is the $1,400 put, it went straight down in value. Therefore, the weekly resistance values come into play, and we will make our transactions based on the next weekly reversal. And we had several weeks going straight down. This is where the selling increased. These are support and resistance levels on the S&P 500. I will conclude that trade management. Not only that, we'll be updating it daily with those entries and exits and profits.